Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial secrets that move the market. Today we're diving into the latest annual report from Click Holdings Limited, and let me tell you there are some interesting stories hidden within these pages. Make sure you subscribe because we break down these complex filings so you don't have to. And join our growing community on Discord, linked in the description below, for even more insider insights. This is essentially Click Holdings Limited's annual report to the US Securities and Exchange Commission. Or SEC, it gives us a look at their operations, their financial health, and the risks they're facing. They've recently gone through some big changes, including an initial public offering, or IPO, which means they started selling shares to the public back in October of 2024. They also had a secondary offering in April of 2025. This means they've been actively seeking public investment to fuel their growth. Now, like many companies operating internationally, they face a complex web of risks. A significant chunk of their business and their employees are based in Hong Kong. This means a lot of their success is tied to the economic and political climate there. There are also ongoing concerns about regulatory changes in China that could impact companies operating in Hong Kong. Digging into their business, Click Holdings is primarily a human resources solutions provider. Think of them as a staffing agency, but they also offer professional services in areas like accounting and finance, and importantly, nursing services. They've been growing and report significant increases in revenue, but there is a catch. Looking at their revenue for the year ending the 30th of June 2025, that is what they call FY 2025, their total revenue was about 83.5 million Hong Kong dollars. This is a big jump up from about 44.1 million Hong Kong dollars in the previous year 2023, which represents a nearly 90% increase. This growth is driven largely by their nursing and logistics services segments, which saw massive expansion of over 200% each year. This is pretty impressive growth, especially in tough economic times. However, here is where things get a bit more nuanced. While revenue is soaring, their gross profit stayed pretty much the same, hovering around 13.3 million Hong Kong dollars in 2023 and 12.8 million Hong Kong dollars in 2025. What does this mean? It means their costs went up significantly to generate that revenue. Their gross profit margin dropped from about 30% to just over 15%. This is a substantial decrease and suggests that the cost of providing their services, specifically in nursing and logistics, has increased considerably. It is like selling more lemonade but spending more on lemons and sugar for each cup, meaning your profit for each cup shrinks. And then there are their operating expenses. General and administrative costs jumped by over 240% from 2023 to 2025. A big part of this increase the report mentions is due to a one-time charge of over 11 million Hong Kong dollars related to share-based compensation for employees, a common practice after an IPO, but also some increased costs related to listing expenses and staff. This surge in administrative costs, coupled with the lower profit margin on services, is what pushed them from a net income of over 6 million Hong Kong dollars in 2023 to a net loss of nearly 8 million Hong Kong dollars in 2025. So they sold more, but they ended up with a bigger loss. Not ideal. For the year ending the 30th of June 2025, they are reporting a net loss of about 7.9 million Hong Kong dollars. This is a significant turn from the net income of 6.3 million Hong Kong dollars they reported in 2023. This is a key point. The business is growing sales-wise, but is struggling to translate that into profitability, given their current cost structure. Looking at their cash flow for the year ending the 30th of June 2025, they used about 6 million Hong Kong dollars in operating activities. This means their day-to-day business operations consumed more cash than they generated. This is often a red flag, and in their case it is largely due to that net loss and some changes in how they manage their short-term assets and liabilities. They did make a significant acquisition in April 2025, buying a nursing care competitor. This cost them about 69.5 million Hong Kong dollars and significantly boosted their goodwill, or the value of that acquired business. This acquisition is a big strategic move meant to strengthen their position in the nursing sector and unlock operating efficiencies. However, it also means a big cash outflow which impacts their liquidity. Now, let's talk about investors. The price of their Class A ordinary shares can swing wildly. This volatility can be driven by all sorts of factors, from their own earnings to general market sentiment, and it can make it hard for investors to predict the value of their investment. They caution that trading in their stock might be subject to penny stock regulations if the price dips below $5. This can add extra hurdles for brokers and buyers, potentially affecting liquidity. A really important point here is about their internal controls. They admit they haven't fully assessed the effectiveness of their internal financial controls. This is something that investors look for as a sign of strong financial management. They are working on it, but it is an area of concern that needs attention. Click Holdings is also considered an emerging growth company. This gives them some flexibility in reporting, but it can also make them less attractive to investors who prefer more transparency. It might also make it harder for them to raise money later. Then there is the concentration of ownership. Their controlling shareholders hold almost 90% of the voting power. This means they can make most major decisions, including electing directors. While this can provide stability, it also means that the interests of these major shareholders might not always align with those of other investors, and that is something to be aware of. So what is my take on all of this? Click Holdings is in a growing market with strong demand for their services, especially in healthcare and logistics. Their revenue growth is undeniable, a real positive. However, the shrinking profit margins and rising operating costs are a significant concern. They are spending more to earn money, and that is a tough cycle to break. The recent acquisition is a bold move that could pay off big in the long run by creating synergies and expanding their market share in nursing services. But it has also increased their expenses and put a strain on their cash flow, leaving them in a net loss position. Plus, the lack of completed internal control assessments and the large voting block held by a few individuals are definite risks to monitor. Ultimately, they need to find a way to cut costs or increase their prices to improve profitability on each service they provide. Without that, they risk seeing their revenue growth overshadowed by mounting losses. That is our breakdown of Click Holdings Limited's annual report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord in the description for more ongoing discussions and insights. See you next time.